My guest today is Ethan Penner, founder and managing partner at Mosaic Real Estate Investors, who is credited with being the primary driver in the creation of the commercial mortgage-backed securities (CMBS) industry. And I'm delighted to tell you that you are going to hear the story behind that in today's episode. Hello, Adam Gower here, and you are listening to the Gower Crowd podcast, Real Estate Syndication in the Digital Age. Now, one of my favourite subjects actually is history. My first and second books were both history, and Leaders of the Crowd, the second book, was about the origins of real estate crowdfunding and how that came about. And so it was with particular fascination that I talked to Ethan about how he created CMBS. And what particularly resonates is that he and I have lived through approximately the same real estate cycles throughout our careers, in the same places actually, nearly, share a great many business acquaintances in common, not the LinkedIn kind of tens of thousands of connections, but real, I have worked with that fellow kind of connections. And I found that he and I share very similar values and overarching philosophy to real estate investing. The most important takeaway really today is that out of chaos comes opportunity, and that you have to adapt and separate yourself from a herd mentality and find alternate paths to navigate crises if you are going to triumph over adversity, no matter what that adversity might be. Now, if you're a regular listener, you'll know that I usually promote either the whiteboard workshop that shows you how to build a fully functional investor acquisition system, or any special offers that there may be on the online courses by the same name. But I'm not going to do that this week, out of respect for Father's Day. Rather, I just encourage you to check out the gowercrowd.com website, where you'll find a massive amount of resources, whether you're an investor or a developer. It's all searchable and easy to navigate. All right, now I am delighted to introduce you to a man who has, without hyperbole, been described as a living legend of the commercial real estate industry, and to hear the story of CMBS, amongst other things, founder and managing partner at Mosaic Real Estate Investors, Ethan Penner. Ethan, thank you so very much for being on my podcast today. I read an article in which you were heavily quoted in Globe Street just a few days ago, or last week anyway, where you were quoted as saying, in reference to the current situation, this is the time where you make careers. What exactly were you talking about?
First of all, because it's been a week, and the current situation a week ago was referencing COVID, and now we have a completely different current situation. We might want to at least mention that. So the situation that I referenced or was asked about in that article had to do with the virus and the impact of the virus on the economy.
Right.
Since then, of course, we've seen our society disintegrate along all kinds of different division lines, and a lot of hostilities in the street, and a lot of different takes on that. And I would say that I'm happy to talk about my feelings about those things, but I'll start by just saying that whenever there's uncertainty, and chaos creates uncertainty, then assets go on sale, right? Their price goes down because investors have to weigh in some sort of a haircut for the uncertainty. Anytime that the United States has been on sale has proven to be an opportune time to invest. And understanding how to navigate that uncertainty and successfully navigating that uncertainty, I think correctly positions one to have massively improved their career prospects. So that's really what I meant by that, and I stand by that statement and explain it that way.
All right, so let me ask you then, what was it about the 90s? So obviously you are dating yourself back to the beginning also of my time in real estate. I go
the beginning of all time, as it turns out, at least for you and me.
Yes, starting in the 1980s, where we first got our taste, I presume also you,
Yes.
of how incredible real estate could be and how it would never, ever go down until until we realized that things are different each time. So tell me, what was it about the
Well,
90s that gave you the sense that careers are made during that time? And how
well,
did
first
those...
of all, yeah, I would say that my career is one that has lived at the intersection of finance and real estate. And I think that the way I look at real estate and appreciate real estate is through the lens of a financier, through the lens of an investor, through the lens of someone who understands that the hallmark of every great investment is one where there's limited downside potential. Real estate inherently is the most superior investment asset for the reason that it inherently has terrific downside protection, far better than any other investment. And so, as a finance/investments person, as I came to appreciate that unique quality of real estate, I gravitated my career, my financial resources entirely. I like to say I'm all in on real estate and have been for a long time. And I don't feel like I need to gain diversification in my own portfolio away from real estate. I think I can get all the equity exposure I need through real estate and all the fixed income exposure I need through real estate. And I think that the downside protection, as I mentioned, that real estate affords, plus I think the unique imperviousness to homogeneity that the real estate industry and the real estate asset class kind of presents itself as makes it inherently less efficient and therefore more rewarding for those who I think maybe spend a little more time or are better at discerning good from bad. So for those reasons, I love real estate. Back in the 90s, I kind of came to real estate from someone who I was someone who grew up in the mortgage finance business as it was being completely remade through the securitization process. And in the early 90s, I observed from the perspective that I had gained as one of the people at the helm of Morgan Stanley's mortgage effort that the commercial real estate market was in disarray. I wasn't the only person, obviously, who noticed that. But I think what I uniquely saw, again, through the eyes of a finance person rather than a real estate person, was that the opportunity existed not only to acquire properties that were being sold at kind of sale prices, but also to fill this massive void in lending to real estate that had been created by the retrenchment of all lenders who all ran at once because of regulatory pressures primarily and bad performance pressures, and left the real estate industry without any source of debt capital. And it just was obvious to me that the securitization mechanism with some modification could be applied to commercial real estate to solve its industry-wide problem. And it turned out I was right, and I had the good fortune to be young and energetic and perhaps right place, right time, right background, right connectivity to the bond buying community through my Morgan Stanley and Drexel years at the forefront of being a structured mortgage credit person, kind of connectivity to the rating agencies, and enough youth and vigor to kind of be the catalyst to kind of make that happen. And the rest is history, as I say.
Right, so
My career was made, really.
So just be clear about that. Tell me something about CMBS and your role in that.
I created it, actually.
So tell me about that, because that's very interesting.
Well, I didn't invent CMBS, right? So CMBS, which is the securitization and pooling or selling of loans, securities backed by commercial real estate loans, I would credit the first deals done to Solomon Brothers and Lou Ranieri and Steve Roth, who later left and went to Drexel and was a colleague of mine and a good friend. And I'm friends with Lou to this day. And they really created the first CMBS model. They did a single asset deal backed by an office building in Lower Manhattan in the late 80s. They tried to roll the business out to become a bigger business, but it was the right idea at the wrong time. And of course, there's an important lesson to be learned there, is that success comes with not just smart ideas and not just smart people willing to work very hard, but there's the magic formula that we don't control, which is timing. So Steve and Lou had a great idea. They clearly had the right firm. They clearly had the work ethic, but they were competing against a wall of really mispriced capital from all sorts of institutional lenders, insurance companies, banks, foreign banks, who were just pouring money into the US real estate market really without regard to price. I remember seeing in the late 80s 10-year first mortgages priced at basically the same yield as 10-year treasuries, which obviously makes no sense. Like, well, how could that be? And of course, you realize that we were living at a time, because real estate was untethered to the capital markets, that happened because there was an absence of relative value analysis because of that untethering. So for those people who can't imagine something like that occurring, because the world has changed thanks to people like myself who brought the real estate market into the capital markets. But back then, real estate lenders, insurance companies primarily, banks, foreign banks, they would get the division that was in charge of lending would get a certain allocation of funds from the company. And they would be told, put this money out this year. Literally, those would be the words that would be used. And as though the money was like a hot potato that needed to be gotten rid of quickly. And believe me, it was gotten rid of quickly, because if you think about the incentive for the lender who's being told, here's $1 billion, get rid of it in January, right? Well, the goal is get rid of it before golf season starts in May, right? And invariably, there would be incredible price arbitrage if you loaned in the second half of the year versus the first half of the year. Because in the first half of the year, everyone wanted to get the money out the door so they can golf all summer, right? This was the quaint world of finance that I grew up in that doesn't exist anymore. And the head of lending at these companies wouldn't really be comparing. There was no benchmarking like, gee, is this a good yield versus corporate bonds or government bonds? This is just like, let's just get the money out the door, right? And make sure we're making decent loans, right? So I'm not kind of poo-pooing credit quality, although of course in every cycle there's credit quality mistakes, and there were then too. But I think that what was the biggest kind of like systemic error was the absence of relative value benchmarking and the rush to put the money out the door.
And that's because the insurance companies had a certain amount that they wanted to allocate to real estate.
Just, yes.
This, and just here it is, real estate. We don't care really. Just get it out the door.
Get out the door and do the best you can. But if everyone's competing against each other in real estate, well, they don't know that they're pricing through treasuries. You know, they just don't look at treasuries.
So tell me, so then what was the idea of commercial
So Lou Ranieri and Steve Roth were competing in that market, and of course it didn't make any sense. You couldn't sell bonds backed by loans when the loans were paying a rate lower than treasuries or equal to treasuries. There was no way to do it. So they had a good idea, they just couldn't make it work. Then came the collapse, the collapse of the market, and all those insurance companies and all those banks literally turned the spigot off at once. Mm-hmm. And so when I came along, it was in reaction to the fact that the spigot had been turned off. I didn't have any competition. Like I was, you know, it kind of almost didn't matter what rate I charged the borrower, because the alternative was losing the property to foreclosure. right? You imagine a great borrower, and he has a great property, and he has a relatively low loan to value loan, it's called 60%, but the loan matures next month. His lender tells him he doesn't want to renew the loan or roll the loan, and he can't find another lender. So he's facing foreclosure and the loss of his property unless I come along and say, I'll refinance that loan for you, and kind of whatever rate I charge is better than losing the property. So,
And then what were you doing though? Just explain to me what it was you were doing. You were giving him a loan, but where were you getting your capital? You were getting it
well,
from the public markets.
initially I started out backed by Cargill and their financial division. I had a little company. I had left Morgan Stanley to do this, and Cargill was my partner, and we would make a loan. Actually, the initial loans we made were cross-collateralized against a portfolio of properties with a single borrower. So we did 2 or 3 larger single borrower, multiple property deals, got them rated. I worked with the rate. There was no model. I worked with the rating agencies to establish a model for analyzing and rating commercial real estate backed securities. And then we would sell in a private placement those bonds, and Cargill and I would get our money back and our profits. Then I met someone from Nomura who really loved what I was doing, and I ended up folding my business into a new company backed by Nomura, and they gave me more capital and a bigger platform, and I staffed it up, and within a year became the largest lender in the United States. So then that became more the CMBS model you see today, right? The making individual loans to individual borrowers that ranged in size from as little as 10 million to as big as hundreds of millions, and then holding them on our balance sheet while we generated the critical mass required to gain the proper diversification to make a securitization efficient. And then going and soliciting the rating agencies rating, selling the resulting bonds, which was no small task into a market that didn't exist, right? You got to remember when people ask me, like you did, who created CMBS or what was your role? And I said, I created it. The creation part that was the biggest challenge was the convincing bond buyers to buy bonds, right? Let me tell you, that was the hardest part of the job, because we were just at the tail end of a catastrophic cycle in real estate. So every bond buyer, like every other investor in the world, was scared out of their minds at the risk of putting real estate risk on the books.
Right.
Bond buyers had never seen real estate risk before, because remember, this didn't exist before. So here comes a 32-year-old kid, right, saying, hey, I've got these rated bonds backed by commercial real estate loans. You could only imagine the skepticism that I had to overcome in order to persuade people to play along and invest. So that was the hardest part. Right?
So tell me, how did you overcome that? What was, to try and cast your mind back? What was it?
Well, people say I'm the best salesman they've ever seen on Wall Street. And I would say, because I want to make this very clear, sales to me is being passionate about something you believe in. I don't think, at least for me, I could not be an effective salesman, or in other words, a communicator of a value proposition, if I didn't personally believe it myself. But when I personally believe it myself, I can be quite persuasive, I suppose.
You can sell it to everybody.
So I think that's what I leaned on. I leaned on my deep, passionate belief in what I was doing, that it was right and good.
Let me just interrupt you. Sorry, while you're doing that. I think, did you put your finger over the mic?
Oh, I'm sorry.
Yeah, there you go.
I believed very passionately that what I was doing was valuable, right, and good for everyone involved. And I had tireless energy. I mean, I still do, but I was only in my 30s then, so I really was quite tireless, and I needed to be, because, like I say, the level of skepticism that I met was pretty remarkable.
So let me ask you, how important was the rating agency component
Well,
to?
it was essential because bond buyers don't buy bonds without a rating. So, but that wasn't the hardest part. And I'll tell you why. You might say, someone who's cynical might say it wasn't hard because you could buy a rating, right? As long as you pay them, you'll get a rating. That's not entirely true. Or it wasn't then. I can't speak to now because I'm not in that business and I haven't been for quite some time. But at that time, they were quite proud of their ratings. And I think that the reputations of rating agencies back then in the 80s and 90s was just like the reputation of investment banking firms, was properly prized and properly protected. I think that we've seen kind of from the late 90s on a disintegration of the pride that people have in their brand, if you will. And so the brand value of a Goldman Sachs today is an embarrassment, frankly, compared to the brand value of Goldman Sachs from the early 90s, maybe back 100 years, okay? It was prized very carefully. Not to say Goldman Sachs is a bad firm today. They may be the best firm still, but the world has seen a disintegration in pride of brand value and what their brand means and stands for. The rating agencies were properly proud back then too. So it wasn't like I could just buy a rating. The reason it was easier than selling the bonds, though, is because the rating agencies very analytical and very logical. And so it really was about sitting down, and I had standing with them, right? They knew me very well from my prior career in structured mortgage finance. So they already understood what I already intuitively understood because we both had that same background of understanding structured mortgage finance. And I was able to speak to them on a peer level. And I think they appreciated it, and I think it worked out very well.
Yeah, it's interesting that you were in Nomura as well, because it was Japanese actually that suffered particularly badly with their investments in real estate in the early 90s. I know because I raised a lot of money from Japan and actually ended up going to Japan in the 90s, and I ended up building real estate for Universal Studios and Paramount Studios, a whole different story. So I actually went to Japan rather than staying here.
It was very accidental, by the way, that I ended up in Nomura. My career before that was Morgan Stanley and Drexel. And I credit two individuals at Nomura with having a pioneering understanding of what I was going to do and the willingness to stand outside of the herd and do what they believed was right. Remember, at that time in 1992 and 1993, the thought of making a commercial real estate loan was anathema. It was something that was, I called it the third rail of finance. Nobody wanted to step on it, okay? But Mike Berman, who ran fixed income, and Max Chapman, to whom he reported and ran the firm, were both they are extremely smart individuals. They saw what I was doing and they embraced it fully, and they made it happen. And as I said, it all worked out pretty well.
So tell me, how do your experiences of that time inform your views and insights of what's going on today?
I mean, completely, actually.
So describe what it was. So what do you see then? Because you clearly have a very unusual, well, you have a unique background and a unique perspective. So share with me what you're seeing today in terms of the commercial real estate industry.
Well, the commercial real estate industry is only as healthy as the economy. So I think that's something that may seem obvious to some, but may surprise people when they realize it's not obvious to all, okay? Somehow people think commercial real estate's values are mysterious. They're not really mysterious. All you have to do is understand the economic direction and I think understand flows of funds, right? Those are your two drivers of value. I think that today, we're definitely seeing some beginning pain that I expect will last for some time. I think that nobody really knows, and anyone who says they do is obviously full of shit. Nobody really knows what the hotel traveler experience is going to be after COVID. Nobody really knows what the office habits and behaviors will be for companies after this. Nobody really knows a lot of things, right? Nobody really knows. I mean, the senior housing experience was pretty damn bad. Let's put it that way. I mean, COVID, I think, killed most everyone that was killed largely was in a senior facility. So who the hell knows, right? In the wake of this, and now we have the protests and riots after the poor individual in Minneapolis was killed, George Floyd. That's very, very sad. And how our society is going to react and how that will play out in economic and kind of lifestyle choices that people will make. Everything's up in the air. And when everything's up in the air, prices typically go down, and capital is held on to much more dearly and parted with only for higher returns. So I would imagine we're going to be in for, and I've said this before, I consider there have been two in my life. I started my career in '82. And so we're in 2000, almost 40 years, 38 years. And I consider two major cyclical downturns in my career. There have been some minor ones, but the major ones were that early 90s period that you referenced, and then the great financial crisis, right? The global financial crisis of '08, '09.
Right.
I think that this will be in league with those two downturns.
This one is a bit different though, isn't it? When even in 1990, in the 90s, when you were creating CMBS, you had to have a belief and a confidence that real estate would pick up again, that there would be recovery. You had to be able to project something with confidence in order to be able to sell to bond buyers. But how do you do that now when there is such a fog about the way that the world is going to look? It's different, isn't it, this time?
Well, here's what I would say. It requires for these moments to be the opportune moments that they are. The world has to look like it's going to end. If it didn't look like it was going to end, things wouldn't be on sale the way they were going to be on sale. So in early 1990s, I mean, that happened a long enough time ago for even us who were in it to forget the magnitude of panic and dislocation that existed in the moment. Even the '08, '09 crisis, which is only about a decade ago, people look back and say, and I laugh, I should have just bought everything. Well, the reason you didn't buy everything is because you were scared out of your mind.
Yes.
Because it looked like the world was going to end.
Right.
And that is the hallmark of these moments. The world has to appear legitimately to the majority of people that it might not ever look the way it looked before this crisis. Like the world as we knew it will end. That's what made both of those special, and that's what makes this special. That's how I know this is a great time, because on the tip of everyone's tongue is, will the world ever look like it did before this? That is the key primer that's required for an investment opportunity and a vintage to be great. So we're for sure seeing that. You just articulated it yourself. And that's why I know it's going to be that way. Now, a minority of people, because that's what makes it great. If a majority of people thought this was a great investment opportunity, it wouldn't be a great investment opportunity. So a majority of people need to be paralyzed by fear.
Yes.
And a minority of people need to be courageous. And a minority of people need to see through the fog you just described and have confidence in human nature and the resilience of societies to recover. And I learned this really only in the '08, '09 crisis. I wasn't smart. I was too young to really be too smart and observant, because only with experience and observation can you gain knowledge or wisdom. It was in the 08-09 crisis when I actually felt in my heart the world was going to, or very likely was going to, end in the way we had known it. And I think that there was a legitimate reason for fearing that the financial system of the world was going to collapse, and that we were going to enter this unknown and unknowable future.
Mm-hmm.
And it was at that very moment that I said to myself, but wait, that could never happen. And the reason that could never happen is because nobody wants it to happen. And the will of everyone together is bigger than anything else, right? So I realized at that moment that the poorest person and the richest person, the weakest and the most powerful person, doesn't want to walk through that door into that black hole of uncertainty. Nobody wants that. So everyone's going to walk back from there, and everyone's going to figure out how to make amends and make patchwork so that we can come back to some semblance of the world we knew. Maybe we didn't love, but at least we were comfortable in. And we're going to make that happen. And whether it's the government printing money, or taxes going up or going down, or whatever adjustments had to be made, would be accepted by everyone without revolution, because people don't want a black hole. So I say that today too. Of course, there are people in the streets today, they don't like the deal that they have had. And by the way, I think that the riots are much more emblematic of the uncertainty than the COVID virus. The COVID virus is whatever it is. I think it was going to run its course, but the deeply rooted societal problems are the ones we should be much more attentive to. And I'm in a certain way appreciative of the rioters for bringing it to the forefront of our attention. And I think that even the rioters, they may think they want anarchy. They don't want anarchy. Okay. They may think they want a new currency without government control. They don't want a new currency. They just want a better deal. Okay. They want a few more dollars for themselves. They don't want Bitcoin. Okay. They want a job. Okay. They want a job. Everybody just wants the same thing. And the rioters are frustrated. They're young for the most part. Young people are facing a bad situation in this world, right? Not just in America. I wouldn't be surprised, here we sit today, June 2nd, 2020, if we didn't see rioting in other countries along the same lines. It's not black, white, or racial. It's really much more socioeconomic. It's about a limited future based because of all bunch of things, including technology displacing jobs. Birth rates have been a certain level.
Well, there's also, Ethan,
levels.
There's also a polarization of political viewpoints. Let's not go too deep down this rabbit hole, but when you can self-select what it is that you hear and how you are informed of the truth, so that you become the world that is informing you becomes an unfiltered stream of news and information that is completely coherent with your own worldview, it becomes very difficult to see anything else. So there are some very different influences on society today than there were certainly in the 1990s, right, where you needed a newspaper for crying out loud to know what was going on. And even in the last downturn where the internet was really just beginning to take over and social media was really beginning to dominate. It's quite different.
I agree with you. I think social media is a factor that people haven't properly appreciated in the separation or fragmentation of our society. And I agree with you. Fixing that's going to be very hard. But I have faith. Things will be fixed.
Let me ask you, let's get back to some kind of real practical questions about commercial real estate, right? So there's definitely opportunity. As you know, we went into this downturn from a very, very healthy economic perspective, right? So the economy was strong. Everything was trundling along nicely. It wasn't an economic crisis going in. It's not the same as the savings and loan and the financial industry issues in the 90s or in 2008. This is different. We went into this with strength. So there's a lot of money on the sidelines looking at the opportunities. It would be nice to think that it was just you and me, right? Looking at these opportunities that are likely to come in distressed real estate, but there's definitely a lot. Where do you think the biggest opportunities are going to be, and how will you know when is the time to strike?
Well, if I told everybody that, I'd be giving away valuable secrets. I guess I would say, just going back to what I said before, if there's a consensus, then it's no longer opportune, right? So you have to, I teach my kids this. If you want to be great, you have to be comfortable being outside of the herd, because there's never greatness inside the herd by definition, right? Greatness means you're outside, by definition means you're outside of the norm, outside of the herd. So greatness cannot be found if you're living and operating within the herd, within a consensus view. So, boy, you just have to be courageous and contrarian is the answer to your question. And that's why it's so hard for most people to do, right? Most investors don't want to be outside the herd. It's frightening, right? And so it's very hard for even a passionate individual who's a good communicator like myself to persuade investors to follow me into a rabbit hole that the consensus is condemning as being idiotic or risky. That's what makes it a good investment, right? So that's why few people ultimately get higher returns and most people get average or poor returns.
So you've talked about this being a potentially a 3-year commercial real estate recession. You've talked about nothing really pulling out until there's a vaccine, right, in place. We won't get back to normality. So tell me something about the scale of where you think we are in this. I'm almost hesitant to say cycle, because it isn't a cyclical downturn. It's been triggered by a pandemic. So where are we in this? And when do you think any opportunities that will emerge are likely to emerge, if you have a 3-year perspective on that?
Well, there's no way to know. I can only give you my best guess. My best guess would be we're in the very early stages. Opportunities are truly scant. In that moment, it's a little bit dangerous, because sometimes investors are so excited about or anxious to invest in what everyone's saying is a great moment that they make mistakes. So think about the analogy to you see two people drowning in the water, and you want to go rescue them both, but you don't know which one of them has like 1,000-pound weight tied to their foot. So if you grab the hand of that person, you will be pulled in and you will die. If you grab the hand of the other person, you're a hero and you'll save them. That's a good analogy to the early part of a downturn. There are some investments where the money you're investing will actually kill you. You're going to get pulled down with the investment. The kind of catching a
falling sword. It's a note I have to exactly.
Usually people look at it, but I like the more colorful one of the same.
Yes, it's quite a good one too. Yeah.
And then the other one, you're a hero. You make a high return. I think that's what's going on early cycle, and I think we're in that cycle. I saw it happen in the global financial crisis. I would say if I were to layer one on the other, I would say we're in the second half of 2007 today. The second half of 2007 was that very early stage where people were getting a sense that things are not quite right. And I remember very well seeing mezzanine pieces in commercial real estate that were, par, being offered at 90, and buyers thinking, wow, this is a great deal. And I would look at it and go, that's not even worth $1. It's literally going to get worth 0, because when the asset gets revalued and someone buys the first mortgage, they're going to get squished. The mezzanine is going to be worth 0. So paying 90, while it seemed great because yesterday it was par and now you get to buy it at 90, that was the greatest example of a falling knife, right? So I saw some of that happening in the fourth quarter of 2007. I think we're in a similar spot today. Maybe a little bit better. Maybe the first quarter of 2008. There's some, nothing's perfect, but it's because I do also see some good deals being done, not all bad deals. Whereas fourth quarter of 2007, there weren't any good deals being done. It was all bad deals. So I think today we're mixed. Some good deals, some not so good deals. I think that will give way to more opportunity, more broad opportunity. But for there to be more broad opportunity, and to your point, there has to be an imbalance of sellers to buyers, right? There has to be more people seeking liquidity than holding liquidity. And until that imbalance presents itself, there won't be great opportunities. So that doesn't exist by and large today, but I think most people anticipate that it will exist soon.
When you talk about the 2007 and that being this moment now, 2007 was not even close to the depths that we actually sank to, which was at the end of 2008.
No,
right?
2007, late 2007, people were still originating loans, and some people didn't even know there was a crisis.
That's
and
right. Yes.
So it was the analogy is somewhere between fourth quarter of 07 and first quarter of 08 to me, where we are now. Because in the first quarter of 08, there was some capitulation, but not much. We're in that spot now. But I think that also people are trying to be patient, right? And banks are being told by the Fed to be patient, because there's an understanding that it's not because of gross mismanagement and, as you say, necessarily over leverage, although I think there was some mismanagement and some over leverage, but the impetus was a virus, right? So I think the orientation is to let's be kind to everyone for as long as we can be as a system. Ultimately, people do what they need to do to protect their own franchise, right? Ultimately, the head of a bank and the regulators to whom they report and the stockholders to whom they serve have to say, protect our interest. I can't really sanction you protecting the borrower's interest any longer.
Right.
And that's when opportunities will arise.
That's when the dislocation occurs. Exactly. Right. That's right. Ethan, what an extraordinary pleasure talking to you. I would love to talk to you for a lot longer, but I don't want to take too much of your time.
You're very kind.
If you don't mind, let me wrap up with 3 questions. Seriously, I would just love to keep on. So I've got another 20, 30 questions here I would love to go through. Well, let's just not do that. I do have 3 sign-off questions that I ask all of my guests at the end of our conversations, just quick sign-off questions. So what daily habits do you have that make you successful?
I would say living in a state of awareness is probably the most important thing. Being in a constant state of awareness, being an inquisitive person, these are qualities more than habits that I think have allowed me to have whatever success I've had in my life, which, as I tell my kids too, is not about monetary success. It's about what kind of a life have you created for yourself. And so that's my aim, is not success as measured by my bank account, but what kind of a quality of life have I created for myself? And so I have a couple of, I guess, rather than habits, it's just approaches to life that I attribute my success to. I'm actually not much of a big fan of habits. I actually think being in a state of awareness is really being in the moment and reacting to the moment in an improvisational way. I think I'm an improviser by nature. I love improvisational living. I think it's the only way to live. And I think that habits are probably the opposite of my approach.
Second question. What's been the hardest lesson you've learned in real estate in your career?
Uh, I've learned quite a few. And some of them have been pretty painful, as lessons can be.
Right.
Um, I've rarely lost money in real estate. I've lost money in venture capital, which is why I'll never do that again. But I've rarely lost money in real estate. And the most painful experience that I really have had, which would coincide with the biggest lesson, I guess, involved being entrusted with people's money because they trusted my judgment. And then conceding to, let's say, a large investor to relinquish complete control over the pool of money, including the money that was entrusted to me and my judgment, and essentially creating joint controls with strangers to the other investors. And that was very painful because there came a moment where I knew it was time to sell, and I had given control or voting control to a large investor who didn't give me the permission to sell. And everyone lost money. And shame on me for essentially betraying the trust of the investors who had unknowingly, who unwittingly found themselves at the mercy of someone that they didn't know, let alone trust, to make judgments on their behalf. That was the worst one.
Very interesting. Last question. Advice for somebody looking for opportunity in commercial real estate today. What advice would you give them?
Well, I would say be forward rather than backward thinking, and you're already probably ahead of the game, and most of your peers. So think about where the world's heading, and position yourself accordingly. And I'll give you an example. Most commercial real estate professionals consider new construction to be at the risky end of the spectrum of how to invest or spend their time or their money, and prefer existing properties. And historically, it's understandable why that might be true. But I would say that over the last 5 or 10 years, we've seen a intense change in the demand for space. It doesn't matter whether it's an office building or an apartment building or a hotel. And the changes are around environmental deliverables, technological deliverables, architectural styles, even locational preferences. I think that there are moments where there's a chasm, like a generational chasm. It doesn't happen often. Maybe it happens every 50 years. They're almost always missed, right? And I think that's being missed today. So I think that while most people still prize existing properties and are fearful of new construction, I think they're making a terrible, terrible mistake, and they're underestimating obsolescence risk and undervaluing the differential in the appeal of new product. So if you put your career on the forefront of the creation of new product, whether it's architectural skills, construction management skills, financing skills, asset management skills, serving new construction, I think you would be well rewarded for being ahead of the curve.
Ethan Penner, thank you so very much for being on my podcast. You're a very, very interesting fellow. It sounds like our careers have paralleled, at least in terms of time.
Yeah, well, we've seen and been part of an interesting journey, and I can wish that for everyone coming in today, that they have an interesting journey, and I suspect they will have a very interesting journey. So thanks very much, Adam, for having me, and I'm glad we were able to do this.
That was Ethan Penner, founder and managing partner at Mosaic Real Estate Investors. The history of CMBS. Fascinating, right? If you find history as interesting as I do, then check out my book, Leaders of the Crowd. There should be a link there on the homepage of gowercrowd.com. But as we're always testing and changing that homepage around to see how it performs, if it's not there on the homepage, you can find the book at leadersofthecrowd.com. Go ahead, check that out. It is a deep dive into the origins of real estate crowdfunding. All right, that's it. Thanks for listening. And thank you, Ethan Penner of Mosaic Real Estate Investors, for your time with me today. It was a real pleasure and really interesting to hear how our views of commercial real estate are so closely aligned. That's all for this episode. I'll see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.